Professor, we are live.
So, good afternoon, ladies and gentlemen. It gives me great pleasure to welcome to you to this uh, Global Money Week, which SEBI Securities and Exchange Board of India, National Stock Exchange, and IIMB's Center for Capital Markets and Risk Management are celebrating this. On this occasion, we have today a very interesting session, a discussion by my colleague, esteemed colleague, Professor Srinivasan Rangan. Professor Srinivasan Rangan is faculty in the area of accounting and finance here at IIM Bangalore. He has been with the IIM Bangalore for the last 11 to 12 years, more than 12 years approximately. He is an authority in the area of earnings management. You can refer his name on the Google and you will get quickly Journal of Financial Economics paper, which is well refereed and well quoted and well cited paper on earnings management. So we have Srini has agreed to give valuable time for this explaining the concept of earnings management because it has impact on stock market. It has impact on investment decisions. So as an investor, what aspects you need to focus on earnings management when you are looking the earnings management of the companies, or how to understand the earnings management of the companies and how it is impacting the stock prices. The discussion is being carried out with the doctoral student of IIM Bangalore, Mr. Prabhu Venkatachalam. Prabhu is working with Professor Srinivasan Rangan as a doctoral student, and his work is almost in the advanced stage, and maybe in the next few months he is going for defense. So Prabhu is a chartered accountant by qualification, and in the advanced stage of completing a PhD degree from IIM Bangalore. Professor Srinivasan Rangan is also a chartered accountant as well as a PhD from Wharton University. So I request both of them to carry on this interesting discussion on earnings management. And you may be having certainly some doubts. Maybe you can raise the hand. We have the coordinator, Dr. Aishwarya is there, and she can manage the discussion, question and answers after the discussion. Thanks, Professor Srinivasan and Professor Mr. Prabhu Venkatachalam for your valuable time. And let us go ahead with the discussion. Thank you very much.
Thank you very much, Professor Jaydev, for the kind introduction. Let me start. Are we sharing the screen now? You're going to share the screen? Great. So welcome everyone. I just want to say a few words to set this up and set the expectations correctly. So I am an academic by training, and I started working on this subject of earnings management more than 25 years ago, and I've thought a lot about this subject and done research on this subject. And so I'm very happy to share my views on this subject. I hope it's relevant for you. I believe it will be relevant to you as an investor. I want to say one caveat. This is a very high-level discussion. It's an overview. So if you need to learn more about this subject, we would have to do more webinars like this, where we can dive deep into a specific topic and learn more about that topic. So it's more like an overview, and I hope you find this discussion useful. Right? So the way we have set this up is Prabhu is going to ask me some questions, and I'll try my best to respond to them as we go along. Thank you very much.
Yeah. Thank you, Professor Jaydev. Thank you, Professor Rangan. So we'll begin with today's webinar. So for everybody who's joining us, could you briefly tell us what exactly do we mean by earnings management when we use that term?
Thank you. Okay, so that's a very good starting question. The way I like to explain this phenomenon, earnings management, is you first need to understand what is earnings. Earnings is the profit of the company. It's the bottom line number that is reported in a company's annual report. And a lot of investors follow that number. They look at earnings per share, they look at return on assets, and other such related earnings measure. Now, you want to think about earnings as reported by a company as a glass of dirty water. So think of a glass which has some water and has some dirt in it. Right? So if you take out the dirt is the earnings management. So if you filter the water and take out the dirt, you get earnings management. And what's left over, the pure water, is the true performance of the company. Right? So you can think of reported earnings as being the sum of two things, the true performance and earnings management. So that's what the last equation on the slide says. Reported performance is true performance plus earnings management. So earnings management, to explain it a little bit further, is designed to, or is the intention of engaging in earnings management by a firm is to distort performance, right? So you have true performance and for some reason, you are trying to distort that performance, right? And you get the reported number. And investors are looking at this reported numbers. And so the interesting question is whether they can figure out what is the true performance of the company.
Okay. So when you say earnings, we're basically saying that these are revenue minus expenses.
Yes.
That's earnings.
Mm-hmm.
So going by what you said, a company could, if you take dirty water, this dirt could be anywhere. It could be in revenues, it could be in expenses. Mm-hmm. And these are various ways in which companies do this. Is that right?
Yeah.
Different components?
You could think about earnings management as affecting revenues. Okay. It can affect expenses. And so there are different ways to manage earnings, and we'll talk more about that later. Yes.
Okay. So the immediate question that comes up is, why should firms be doing something like this? Why should they even manage earnings in the first place?
Very good question. So there are several reasons. So academics have delved deep into this topic to find out why do firms manage earnings? And we can think of several interesting reasons. I'll give you one example. The slide indicates many reasons, so we won't have time to cover all of them. The first reason would be, suppose you're a firm that is trying to raise money from the capital market. So you're doing an initial public offering, or in India, we call it a secondary offering. In the US, you call it a seasoned equity offering. So you're raising capital for the second time or the third time, right? So if you're raising capital, your objective as a firm, you're the firm, and your objective is to raise as much money as possible from the investor. So that means you want to make the price per share that the investor pays when they invest in the company to be as high as possible. Now, if investors are going to rely on the reported numbers, the reported earnings numbers to make their decision, then managers may say, okay, yeah, they're going to look at the earnings per share, and based on that, let's say they have a multiple of 20, so they're going to give us 20 times earnings. So let's try to boost the earnings. And if the investors are naive and they don't know about earnings management, they end up paying a higher price, right? So the managers are happy, they get more money. And so that would be one example of where earnings management can go on. I'll give you one more, another interesting one, which is fairly popular, both in the financial press and in academia, is insider selling. So promoters from time to time may sell shares. So imagine you're a promoter and you're trying to sell shares. You have some shares in your own company and you want to sell them. So your objective would be to sell the shares at the highest price possible. So what you might do is inject some earnings management into the earnings, make the earnings go up. Investors look at that and think, yeah, this is a good company. Let's buy more shares in the company. And the insiders would be basically selling to those guys who are buying the shares. So they exit the company, and the investors who buy these shares are left with a company which doesn't have such good earnings, actually. Right? So those would be a couple of examples where I think firms have incentives to manage earnings. Right?
So is this something that's studied a lot in accounting research? Do we know from the industry that people are engaging in things like this?
Yeah, definitely. There's a lot of research on it. I'll mention one particular study in a minute, but I think the main thing you want to understand as an investor is the human nature. So the CEOs who are running the business and the CFOs who are working for the company and the accounting team, they're all human beings, And from time to time, they are afflicted by greed and short-termism. So they may say, I want to make more money. And so this propels them to engage in this nefarious activity of managing earnings or manipulating earnings. And we see a lot of cases of frauds which have come out in the last 10 years, famous companies, and this has been going on for time immemorial, right? So it's the greed of the managers which propels them to manage earnings. And the second thing is the managers assume that investors are naive. So if investors are smart and sophisticated, then they should be able to figure out that the firm has managed earnings. And we'll talk about how you as an investor can figure this out, right? There are red flags for that, and we'll discuss that later. But to answer your question about academic research, so yeah, a lot of us academics have done research on this subject, but a very famous study by these three professors in the US, Graham, Harvey, and Rajgopal, right? So these three professors, they did a survey of Fortune 500 companies in the US, and they surveyed 401 financial executives. So they asked them these questions like, do you think firms manage earnings? Very plain, blunt questions, right? And why, and they asked them the same question that Prabhu just asked me. Why do you think firms manage earnings, right? The answer was very surprising because firms came out. It's not like they were talking about their own firm, but they were talking about other firms. But they came out and said a majority of them said firms do manage earnings, right? And they view earnings per share as something that an investor would care about and is worthy of manipulating, right? So earnings per share is a very important, widely followed metric. And so the bottom line of that study is firms do manage earnings. So this is something the executives confess that they do this. And another thing, interesting thing is a majority of them say that suppose a firm has a project, which is a positive NPV project. That means it's a very good project. It's worthy of taking and pursuing in order to increase shareholder value. But many firms would forego that project. They may not take up the project because that if that project is going to reduce earnings per share, that would make them look bad in the eyes of the shareholder, and therefore they would forego the project. So the point is earnings per share is a widely followed metric, and so firms have incentives to manage earnings, right? So, and this does go on. And so as investors, we should be cognizant of that.
Okay. So to sum up what you just said, there is a firm, that firm has for a certain period has performed in a particular manner, which is measured using revenues, expenses, operating your earnings, and then finally you get your EPS, right? So earnings management basically is when what they're showing is not what is actually happening, right? So how do they do this?
Okay.
How do they manipulate these numbers?
Okay, so there are a good question. There are actually a wide variety of ways in which you can manipulate earnings, right? So I'm just going to highlight a couple of them, which are the more prominent ones in the academic literature. So the first one is what I would call as manipulating the numbers, right? So another word that we use in academic literature, we call this accruals-based earnings management, right? So you manipulate the numbers. Your true performance is, let's say, 200 rupees a share, earnings per share, and you add a certain amount of earnings management and you make it 220 so you look good. And that is achieved by using certain methods, which I call accruals-based earnings management. There's another one which is not so well known in the Indian setting. So if you're an Indian investor, you may not be familiar with this, but this has become very commonly studied by academics, and that's called real earnings management. So you don't really violate any accounting rule, but you manipulate transactions so that you get a higher earnings per share. And this is also not a good thing because it may not be in the best interest of the shareholders for you to do that.
Okay. So who typically does these things? So in a company is a composite of so many people, right? Mm-hmm. So if you're looking at the first scenario that you were talking about, which is just the numbers. Mm-hmm. So I'm guessing that there are accountants involved who are doing this. Sure. And if you're talking about actually manipulating transactions, so does it mean to say that people at the shop floor, if it's a factory, are those people also involved? Are they even aware of what they're doing?
Yeah, good. That's another good question. So if you think about accruals-based earnings management, to set this up, to answer this question well, you want to consider that a firm has reports every year. So it has something called a fiscal year, which usually runs from April, in India, from April 1st to March 31st. So during the year, you're selling products, you're incurring expenses, and at the end of the year, you have a certain profit number. And this is because generally, most of this is because of actual transactions. You've engaged in certain sales, you've paid for certain expenses, and so on. Right? Now, after the year is over, the accountants have a meeting, the CFO and the accounting team, and maybe the CEO get together, and they have to do certain additional work to make sure that performance is correctly reported, right? So here, this is where they record certain adjustments. So now some of these adjustments are valid and bona fide and consistent with accounting law, but some of these may be in the region of earnings management. So they may manipulate. So this accruals-based earnings management actually happens, most of it may happen after the year is over. And since it's being done by the top management, the accounting team, like you said, the people in the shop floor or the sales people may not be aware of it, right? But when you're talking about real earnings management, so one example of real earnings management is you're a salesperson and you're at the end of the year, you're close to the end of the fiscal year, and you are pushed to achieve certain sales targets. So we call this channel stuffing, right? So you're pushed and everybody is going out at the last day of the year, you'll see a bump, a big spike in sales because the salespeople are being asked to hit the customer hard so that they get higher sales, right? So that kind of activity would be known to at least some of the staff down the organization.
Okay. So if companies are engaging in things like this, what role does an auditor play in all of this in terms of monitoring all this which is going on? Are they able to detect both real and accrual-based earnings management that you just spoke about?
Yeah. So auditors have a very important role to play. So their role is to evaluate the quality of the financial statements. They have a lot of technologies at their disposal. They do sampling they verify transactions, they evaluate the estimates that the accountants make, and so on and so forth. And so they have a very important role. But still, because of the nature of this process, because it's a sampling process, it's possible the auditors may not be able to detect certain types of fraud. And so sometimes you see a fraud being announced and coming out in the news, and you might be wondering why the auditor could not detect it, right? So that's because the nature of the process, it's an imperfect process. The auditors try their best to detect this fraud, but some of it may not meet their eye, right? And so we have to, certainly we have to strengthen the audit process in India, and auditors are working toward that, in that direction, and regulators are working in that direction. And so all of earnings management cannot be detected by auditors. Okay. Yeah.
So for someone who's new to this, could you put some numbers to this whole setup that you've just explained?
Sure.
And show this.
So let's make it very simple. Think about earnings management as some kind of a borrowing game, right? So you have some income that is based on your true performance, and you want to increase it, right? Using earnings management. So how would you do it? Typically what happens is you try to inflate your revenues or you try to decrease your expenses. And invariably especially with accruals-based earnings management, the way you do it is you borrow income from the future, right? So there is an amount of revenue that you're supposed to record in the future, but you violate the accounting law and you pull that revenue forward and record it today. So that's what I call by borrowing income from the future. So you're moving revenues from the future into your current profit. And similarly, you may defer expense recognition. So you have expenses which actually belong to this current period, but rather than recording them today, you use your earnings management skill and push it to the future so your profit looks higher, right? So that's one way you would manage earnings, right? I'll give you some numbers in a few minutes. So like I said, that's called borrowing income from the future. Less common is this idea that sometimes you may want to show lower profits for certain reasons, right? So I'll give you an illustration of that. Suppose you're a very, very large company or you're under the scrutiny of a regulator. The government is after you. They think you're too big and that you're a monopoly. And so if you're too big and your revenues are very high and your profit is very high, so you come under the scanner of the regulator. So you may want to show yourself in a poorer light, right? So in that case, what you may do is you may decrease your current revenue and you may increase your current expense, right? So that's another form of earnings management, less common, right? So these are the broad ways in which you would manage numbers. But let me, like Prabhu was just asking me about specific numbers, let me give you a numerical example to make this very much more clear, exactly how these things manifest. Okay, so I'll give you a simple example. Here you have a company, let's think of a simple company, and it's 4 years of data. And these years are labeled as year -2, year -1. Year 0 is when the earnings management is going to happen. And then you have year +1. Okay. So here's a company, which is our utopian company, which does not do any earnings management. Let's say this is a perfect world. Managers are very altruistic. They report the truth. Auditors do their job perfectly. So you have a company which has cash profits. So I use the word free cash flows, but think of it as cash profits. So your cash collections less your cash expenses. And that number is, let's say, $12 a share. Okay. And the assets, that's the investment made by the company to generate these cash profits, let's say it's about $100 a share, right? So you're $12 of cash profits and you have $100 of assets, right? And let's say there's no earnings management, and for simplicity, let's assume your profit is the same as your cash profit. So there's no earnings management, there's no manipulation. So your profit that you report, your earnings per share, is also $12 per share, right? Now, a popular metric on the street, a lot of people follow this as return on assets. So you take your earnings number and divide it by your assets to find out what is your return on your investment, right? So if you do that calculation for this company, so they have a profit of 12, they've invested assets of 100, so their return on assets or return on investment is 12%, right? So I'm using these words a little loosely. There are a lot of different return metrics, but let's just go with this example. So they have a return of assets of 12% in year -1, in year 0 and year +1, right? So what's happening here is the assets are measured at the beginning of the period and your profit is measured in the next year. So you're investing in a particular period and you're generating a profit on that in the next period. So you get a flat return on assets. Here I call it return on net operating assets of 12%. Now let's make this game interesting, let this picture interesting, and add some earnings management. Let's say in year 0, the firm is trying to raise capital. They're going to go public. Okay, so they want to raise capital in year 0. And so what do they need to do? They need to inflate their earnings, right? So, so here's what's happening. So I'm going to add $10. Let's say they are able to do this. How they do it, we'll come to later. They add $10 of earnings management. So their earnings per share goes up $22. Now, here's the interesting thing that a lot of people don't know is that when you manage earnings upward, there's going to be an impact on the balance sheet as well, right? So not only do your earnings go up, because of double entry bookkeeping, your assets also go up by $10. So your earnings go up by $10. So your assets go up by $10. Overall, if you calculate your return on assets, remember the formula is your current profit divided by last year's assets. So in this case, you're going to get 22 divided by 100. So your return on assets has gone up by 22%. Huge spike in earnings per share, in return on assets. Investors are looking at this company. They think it's a great company, but they don't know. Let's assume they don't know that the reason the earnings went up is because of earnings management. Now you come to year -1. What happens is invariably, you can't fool all the people all the time. That's the nature of this universe, right? The natural law of this world, right? So you inflate earnings in year 0, next year, your earnings are going to drop unless you manage earnings again, right? And you have to continue to manage earnings. Let's say you didn't do that. In this example, what will happen is your next year's profit will drop to $2, right? So your regular profit is $12. So you'll make that regular profit. But this $10 of earnings management that you made in year 0 will reverse. So it'll become a -10. So your 12 minus 10 will become $2. And your assets were, beginning assets were 110. So you have a return on assets of 2 by 110. So you have a double whammy. On the one hand, your profit drops. On the other hand, your assets are denominator is higher. So you drop from 22% to 1.82%. Right? So that's how all the frauds that get discovered, when you see these in the news and you see earnings plummeting after the fraud is discovered, this is exactly how it happens.
So I have a question here. Now we are looking at the free cash flows which are staying constant. Then you have the operating income which is fluctuating.
Yeah.
You mentioned accruals earlier, right? So accruals is basically like a complement of the free cash flow portion. So is it the same if you observe the accruals and if you observe the cash flows, or is it better to focus on cash flows from as an investor? Would it make any difference?
Okay, so that's a good question. Both these measures, so Prabhu's question is more about, there are two measures, there's profit. And if you let's make it a very simple exercise. You can think of profit as having two components. In this example, there's cash profit, which is $12, and accounting profit is $22. So the accruals are $10, right? So the total profit of $22 has two parts: accruals, which is their earnings management, in this example, of $10, and cash profit of $12. Now, as an investor, what should you focus on is a good question, right? So both have pros and cons. So if you think about cash flows, cash profits are very good because they are verifiable numbers. You can't really manipulate them a lot, but later on we'll talk about real earnings management where you can manipulate cash flows also. This is not so well known, right? But in general, you can think of cash flows as good numbers because they are verifiable and hard to manipulate. Whereas the accrual numbers are manipulable. So in that sense, they're not so good, but accruals have a positive to them. So in this example, all of the accruals are earnings management. But in the real world, you can't say, this is a numerical example, you can't say all of the accruals are bad. There are some good accruals also, right? So in general, if you sell, you're a young firm, you're selling on credit. So you're selling on account, you have a lot of credit sales. That's an example of an accrual, right? And that's good, and it's important that you record that and communicate that to the investor. And so high accruals are not necessarily bad, but they have some bad parts to them.
Okay. So let's go back to the setting that you were explaining. You were talking about IPOs and how firms manage earnings just prior to going public, right? Could you, again, I asked you for numbers. This is a hypothetical example. Could you point us to a little more in terms of specifics, in terms of how this happens?
Okay, very good. So here's a specific example. This is a research study conducted by 3 professors, Siu Hong Kyo, T.J. Wong, and Geeta Rao, about IPOs. So here's, if you look at this table here, what we see is the year of the IPO is the year in which a firm goes public, right? So let's say it's 2010 and the firm goes public or does an IPO in June of 2010, okay? Sometime, something like that, right? And then the next year, which is 2011, is what I call year 1, 2012 would be year 2. And so what this research study shows is they track the performance for a large sample of IPOs. How do these firms perform over time, right? And if you look at their profitability, which is their earnings per share or income divided by sales, in the year of the IPO, the profit divided by the margin was about 4.6%, which is pretty good. But the following year, it dropped to 2.8%. And then thereafter, it dropped to 2.1%, 1.6%. So very similar to the numerical example that I showed. So profitability peaked in the year of the IPO and then dropped off in the following years. Now, if you try to investigate, what they try to do is investigate what caused this pattern, and they looked at accruals, right? So if they looked at accruals, and it turned out accruals peaked in the year of the offering and then dropped off. And in fact, it became negative, right? So this is evidence that these IPO firms actually did manage earnings during the year of the offering, caused the profit to go up. And because of that, investors paid a larger sum for this company, and that's not a good thing, right? So there's another piece of evidence here. We can talk about this later, where the study showed that they also managed an expense component called bad debt expense, which in the slide it says allowance for uncollectibles. In practice, we use the word bad debt expense. So they tended to record too little bad debt expense in the year of the IPO, and then it started shooting up post-IPO. Right? So this is an example of a research study which documents this behavior.
Okay. So I think one very important takeaway from all of this is that, we tend to focus on yearly annual reports and how firms report their performance year on year. But even before you actually plan to invest in an IPO, I think there's a lot of care that must be taken if you're looking for a long-term investment in that firm. Right?
Definitely. So reading the financial statements carefully, and we'll talk about red flags in a few minutes. looking at these red flags, evaluating these red flags is a good thing for an investor to do before they invest in a stock.
Okay. So what are the other, I mean, we're talking about accruals at a broad level. Can you give us, can you break down accruals a little further and tell us what are the opportunities that managers have to manipulate earnings?
Sure. So like the slide shows, these are examples of ways in which firms can manage earnings. So it's very interesting. There are so many different ways that a manager or the CFO or the CEO of a company can engage in earnings management. So that makes life harder for the investor, right? So you need to be aware of the different ways in which profits can be managed. So the main thing, again, the main bottom line, in a way, pun on the word, the bottom line is that you should be careful and not take the profit number as at its face value. You want to understand how the profit number was created. So here are different ways in which it can be manipulated. For example, the first one is booking revenue before it's earned. So you are generating revenues and you are, based on your business model, but there is some gray area in terms of what can be recorded and what cannot be recorded. And sometimes companies may violate that gray area, right? And they book revenues higher than what they should, right? So this is going to boost your profit. Similarly, I talked about bad debt expense. So this is a particular expense which involves non-collection losses. So you sold stuff to your customer and you don't expect to recover the full amount from the customer. That's called bad debt expense. So sometimes companies can play a game where they record too little of that, and that causes the profit to be higher, right?
So can I ask a question here? When you talk about bad debt expenses, this is, I mean, it's more pronounced in the banking industry, is that right?
Yeah, good question. So bad debt expense is common in multiple industries. So we use the word bad debt expense when we talk about manufacturing companies or service companies. In the banking sector context, we use the similar concept is called loan loss provisions, right? So you have lent money to a customer and you think this customer is not likely to pay the money back, then you've got to record an adjustment to your profit using something called a LLP or a loan loss provision. And that is going to reduce your profitability, right? The question there is, are you recording enough expense? And there's a gray area, so banks may not record enough loan loss provision, and that may cause their profit to look much higher than what it should be.
So this is also where probably, like you were mentioning earlier, accruals become very, very important. I mean, the accrual numbers are more important than the cash numbers because they're reflecting a reality which is actually more relevant, right? Please go ahead. I think there are
a few other examples I want to mention with inventories. Before we go on, I want to mention research has shown the most common way in which firms manage earnings is revenues. So 50% in the US, for example, 50% of all the fraud that is done by companies, accounting fraud, relates to revenues. And the second biggest area of accounting fraud is inventories. And the way inventory fraud works is that you have a certain amount of inventories, which is the goods that you're buying and selling. And what managers may do, they may use some accounting methods to overvalue these inventories. So when you overvalue inventories, what happens is your profit becomes higher, right? And so that's also, that causes your profit to be higher in 1 year. And next year, what happens is we take what is known as a write down and the profit comes down, right? So the pattern repeats, right? So you boost earnings in one period and then it comes down, right? So another example I'd like to, and I mentioned this again in the context of a real world case, is misclassifying expenses as assets, right? So here it's a very simple thing. You're a company, you've spent some money. So the question is, how do you label this spend? Do you call it an expense or do you call it an asset, right? So if you spend something, let's say we think of something like repairs and maintenance. All the companies in the world engage in repairs and maintenance, especially manufacturing companies, right? So you're spending money on repairs and maintenance. Now, if you call that an expense, you're good. That's a legitimate way to classify the transaction. But if you choose to classify repairs and maintenance as an asset, call it as part of the cost of the plant, what that does is because you're not calling it repairs, your profit is higher and your assets are also higher, right? So that's another way companies engage in earnings management, right? So there are other ways. So I have a few more examples here, and I don't know how we are doing on time. If we want, we can talk about one more example. So one more example is a very common trick. In fact, let me give you an anecdote. There's a guy whose name is Barry Minkow. So Barry Minkow he started a company called ZZZZ Best. Now, if you look at a company like this, you would not want to invest in this company, right? But this company was listed on the New York Stock Exchange. It was sold by a top investment banker as an IPO. And the service offered by the company was a carpet cleaning service, okay? It was a bogus company. They had no assets. They had just one office, but nobody read the prospectus. Many people invested in this company. And then within a few years, the company went bankrupt and Barry Minkow went to jail. The story doesn't end there. Barry Minkow comes out of jail. And as a repentance for his misdeed, he made a video, which is the top 10 ways you can manage earnings. And one of them is that many companies stretch the useful life of their assets. So if you think about, if you're an investor, every company has these assets like plant and equipment, buildings, and they have a useful life. So a building may have a useful life of 40 years. Plant may have a useful life of 20 years, right? So what happens is, if you increase the useful life, so let's say that's the true useful life. And instead of making the useful life 20, which for a piece of equipment, you make it 25, your depreciation per year is going to come down. And no one is going to know. There might be a small footnote in the annual report saying that they increase the useful life. And if you've not read that footnote, you'll find the depreciation expense is falling, profit is growing, and you'll think this company is a great company. All they did was to stretch their useful life. And that's a very common way to boost profits. So these are some of the examples I can think of, but there are many more examples, right? So we don't have time, but these are interesting ways to boost profit.
Okay, so as an investor right now, it's pretty scary to know that firms now have the luxury of, firms do engage in all of these things, right? Yes. I think that's what you're saying, and research documents that. So there is an audit process that happens, and despite that, there is some amount that is undetected by the audit mechanism. So you have companies engaging in all these things. Mm-hmm. So let's say I'm an investor who is investing in a company in the long term, right? I'm concerned about this company. I want to track it for a long period of time. Mm-hmm. I want to follow it. I know that industry well. Mm-hmm. So are there ways in which, like you just said, increasing the useful life of assets? So that, I mean, the next time I see something like that, that's one possible antenna going up saying mm-hmm. that, okay, now there's something going on over here. Sure. So are there other mechanisms like this that kind of indicate that you need to be a little more careful and look at this a little closer?
Sure. Right. So your opening remarks in this question, I just want to address them briefly and then come back to your question about specific red flags that investors can use.
Sure.
Right. So I want to be a little fair to the CEOs of India and the corporates of India. In all fairness, there are many good CEOs and there are many good companies which are not managing earnings. The point is, but there are many companies that do manage earnings which go undetected. And the reason, like I said, it goes back to the reason I mentioned. Whenever greed rises in the heart of an executive and short-term, they are very short-term oriented, this can happen. So as an investor, you should always take the conservative approach and say this, regardless of this company and its history, you should be a little wary and watchful, regardless of whether it's a blue chip stock or a small stock, you should be careful. Because let me give you an example. Xerox is a famous company. Xerox was caught for managing earnings. Procter & Gamble has been caught for managing earnings in the US. Microsoft has been caught for managing earnings by the SEC. Right? So large companies do this. And so we should be as investors, we should invest time to detect this behavior. So let me answer Prabhu's specific questions about what I call red flags. So you are an investor and you have it with you, you have an annual report in front of you. What can you do? Right? So this advice, so think about it as there are stocks that you want to buy and stocks that you want to avoid. So this is more about stocks that you want to avoid. Identifying good stocks is more difficult than identifying bad stocks. So to identify bad stocks which are engaging in earnings management, here are some of the red flags. So the first thing I would do is compare your cash profit with your net profit. Right? generally cash profit will be larger than net profit. That's the way accounting works. So you see a company, it's cash profits. We call it in the, if you look at an annual report, open it, if you have one, you'll see a cash flow statement. And in that statement, there's something called cash from operations. Okay. So this cash from operations is what I refer to as cash profit. And if that number is lower than book profit or earnings per share, or your, the bottom line number in your P&L account, that's clearly a red flag. There's a prima facie case for earnings management, right? Second, you want to look at the footnotes and see if they've changed any estimates. Like I was telling you a few minutes earlier, if they've changed their estimate related to useful life, right? There are similar estimates that you could change and cause your profit to increase, right? So you want to read the footnotes and become a little bit more educated about reading the footnotes, right? The other one, which is interesting, is you could have a company which looks very good, its sales look very high, the sales are increasing, but a large fraction of those sales could be non-recurring. I'll give you a practical example of this from the US. There was a company called Cineplex Odeon. If you are from the 1970s, you lived in the 70s, then in the Chennai, there used to be a theater called Odeon. So Cineplex Odeon was a theater company. Okay, so all they did was their main source of revenue was ticket sales. So they had theaters all over the US and their revenue was ticket sales, right? So one year they had pressure to increase earnings. So what did they do? They sold off a piece of real estate. They sold a theater and made a huge profit on that, right? And in their profit and loss account, when they disclosed revenue, they added the gain on the sale of the theater to their ticket sales. And they didn't tell the investors. So when the investors look at this number, they're saying this profit has gone up big time. The sales have gone up, so this company is doing well. When in fact, a large fraction of that sales was just a one-time gain from the sale of the theater, right? So unless you read the footnotes, you would not know that. And so you want to look out and find out how much of the sales is recurring, how much of it is non-recurring, right? The other one I'd like to mention is, suppose your company is having very low losses, very low profit, really tiny profit, then that's also a little suspicious. Okay, so you're just barely managed to avoid a loss. You have a small profit of, let's say, 50 paise per share, right? You've just beaten the loss cutoff. And then it's very likely that you got to that point, you were, without the manipulation, you were actually losing money, but somehow used some accounting trick and you were able to cross the red line, right? So, and you moved from the red to the black, right? So that would be very suspicious and I would avoid such a stock. And so similar targets. So companies are always trying to meet targets. They're trying to beat analyst forecasts. They're trying to make sure that their profit is increasing. So any behavior where you see small changes in profit or just barely meeting analyst forecasts or beating them, that would be suspicious. Okay, so there are, we already talked about accruals. So accruals are very high. That would also be an important red flag to look for.
So I have a very basic question here. Mm-hmm. So if, like you said earlier, accruals are reversing in nature, right? And if I'm in a company in the long term and I'm investing in the long term, and if these transactions are going to keep reversing, does it really make a difference in the long run? Or does all of this point to something else that we have to be more careful about?
Okay, so this is a good question. Actually, research is still working, or we are still working on this particular question. So I want to clarify accruals. Like I said before, all accruals are not bad. So if you look at the sequence of accruals, we call this time series analysis of accruals in academic research. Some accruals, suppose accruals increase in one period. The question you will have as an investor is this a permanent increase or not? It turns out some of these accruals reverse. That's the earnings management. Okay? Whereas some of the accruals tend to increase over time, and that's good accruals. Right? So I would say this is a very difficult question to answer in the sense that we need sophisticated research to find out if accruals are good or bad, and that's still ongoing. In the meantime, till we get the answers to this question, I think simple red flags like the ones that we have on this slide, looking at the relationship between cash profits and net profit, what is the level of accruals? If it's very, very high, it's worth looking. Is there a lot of non-recurring income? Then avoid such stocks, etc. Right? So it's a hard question to answer in a way.
Okay. So some of the examples that you mentioned were referring to the US.
Mm-hmm.
How does India compare to the US? How prevalent is all of this in India?
Okay, thanks for that question, Prabhu. Here's a study that I just recently completed. Okay. This is with a PhD student, Nikhil Vidani at IMB, and my co-author, whose name is Murgi Krishnan, who's in the US. And what we did is this is part of a larger study, but what we did here is we took the earnings per share number of all the Indian companies and did a frequency plot. So like a histogram. So if you look at this plot, on the x-axis, what we have is earnings per share, and that runs from the plot is truncated so that it's more meaningful, and it ranges from -2 rupees per share to +2 rupees per share. Okay, we look at the frequency of each interval. So if you're looking at the frequency of firms that earn between -2 rupees per share and -1.9 rupees per share, there'll be about 5 or 10 companies, right? And we did these frequencies for each bin. And what we find interestingly, this is very consistent with the pattern in the US, is that just around 0, if you look at just to the right of 0 in this picture, you'll see a huge spike. It's like a discontinuity, right? So there are very few firms which have negative earnings per share, and there is a huge increase in the number of firms that have a small profit. This is what I was referring to earlier. When you see a firm which has a very, very small, tiny profit or tiny earnings per share, these are likely to be firms that were actually losing money, but somehow use earnings management to go to the right. So this discontinuity suggests normally if there's no earnings management, the plot should be smooth. You should not see a discontinuity. And what we observe in India is there are a lot of firms that are moving from the red zone, which is the loss zone, to the profit zone. And they're probably using earnings management to do that, right? So many of the results that are applied to the US do translate to the Indian setting also.
Okay. So we spoke about accrual-based earnings management largely. In the beginning, you mentioned that firms also engage in something called real earnings management. And this is where they actually manipulate the transaction itself, right, rather than bookkeeping entries.
Sure.
So could you give us an overview of what real earnings management is?
Okay. So I was going to talk, I'll come back to these examples in a second, but real earnings management is very interesting, and there are many ways in which firms can manage earnings using transactions, right? So I mentioned, let me start with the one I mentioned before, which is channel stuffing, right? You're a salesperson and you're trying to meet a sales target. So you get pressure from the top management asking you to push out a product at the end of the year. So that would be an example of real earnings management. Okay. Another one would be you're trying to meet an earnings target and you cut your R&D spend, even though it's not good for your shareholders. So you have a lot of R&D spend. You're a pharma company and you're spending a lot of money on R&D, but you are having pressure from the stock market. You want to make your earnings per share look good. And so you cut your R&D spend or your marketing spend, and that boosts your earnings per share. So these are activities which are not good in the sense they are increasing your short-term profit, but in the long term, the firm is not going to be better off. So the shareholders are going to suffer in the long term, right? And the other one, which is very common, is related party transactions. This is very relevant to the Indian setting. So these are transactions between the company and the managers of the firm, so the promoters, right? So you could engage in nefarious activities where you are lending money to the promoter, the firm is lending money to the promoter, or they're selling to the promoter or buying from the promoter. And they are using this to manage earnings or influence their profit, right? So these are examples of what I call real earnings management.
Okay. So when you manage earnings through this route, does it reverse or is it something that's permanent?
It's hard to say. Some of it might reverse. For example, if you're cutting R&D this year just to meet an earnings target, next year you may come back and spend more on R&D, and that you'll observe an earnings reversal there.
Okay. And in terms of detection, how easy or difficult is it to detect real earnings management, and how do we go about it? Are there any red flags again?
Okay, so I think again this is a little more. Real earnings management is harder to detect. There are models to detect this, which is beyond the scope of this webinar, and we can talk more about it later. But I'll give you specific examples of real earnings management in the form of related party transactions. So for example, you're a company A, and you are renting, you have a premise that you're renting from a person, Mr. Y. And Mr. Y, interestingly, is related to a director or a promoter of the company. Okay. And this person is promoter X, right? So what may happen is, because you care more about the promoter, the company, because the company is influenced by the promoter may engage in this transaction so that his relative, Mr. Y, is going to benefit. And the shareholders are going to be worse off. So they may end up, the company may end up paying a lot of rent to this relative of Mr. X, and that's not good for the company. So that would be an example of a related party transaction. In this case, of course, it's going to reduce your profit. But think of another example. Suppose you are company B and you're selling to W, who's a relative of the promoter. And you know this person W is not a good person in the sense he or she is not going to pay the money. So you've sold the product to the W, and you have information as a company that this person is not going to pay this money, right? But yet you book the sale and boost your profit. And so in that case, the profit is inflated because it's not your true profit. Your profit should be lower because it's not really a sale in the real sense of the word.
So we have, like you said earlier, there are firms in India which are good firms. They don't engage necessarily in earnings management, and there is a fraction who do engage in earnings management. So from an economy perspective, how does it impact the overall economy when firms do things like this? How does it affect the market? How does it affect the economy?
Okay. I would say, to answer your question in a different way, is earnings management good or bad? So I think it depends upon whom you're talking to. Imagine you're a firm that's engaged in earnings management, and the earnings per share of this company has gone up. You're an investor, you're looking at this company, you may know that this earnings management has happened, but you're a short-term investor, you don't really care about the long term, and you're going to get out of this company. So if the earnings per share has gone up in the short run, and if you believe others are not going to undo this earnings management, you may end up buying the share, right? So that's not a good thing, but from the short-term investor's point of view, that makes sense. If you're a long-term long-term investor, earnings management is not a good thing for two reasons. One is the profit is going to reverse, the earnings management is going to reverse. So in the long run, your profit is going to be lower. And second, it's a bad sign about the company's governance. So in that sense, you're better off not investing in this company, right? But in general, I would say it's really more earnings management is not good for the economy. So think about it. In the last I'm doing research on projects in India. The last 30 years, about 80,000 projects have been announced by Indian companies and government departments. Many of these have gone bad, right? So some of them have gone bad because of pure bad luck, but some of them have gone bad because they've gotten funded by people who are naive, shareholders and lenders. And some of it may be because of earnings management, right? So you want to be, so it's really bad if an earnings of a company got funded, even though its earnings were bad, and it was high because of earnings management. In that sense, it's not a good thing for the economy to have earnings management.
Is there a way of quantifying what is the extent of earnings management in India?
Sure.
Is there a way to put this?
Yeah, SEBI actually sponsored a study, and I've just shown that on the slideshow. So this was a study conducted in 2013, and basically this study showed that on average, the amount of earnings management is about 2.9% of the assets. So they looked at about 2,000 odd companies, and they find it's about 3% of the assets, which is a fairly sizable amount, right? So if you think about it, ROA, return on assets, is about 10% or 12%, right? Of that, 3% is earnings management. So that's fairly significant and something to worry about, right? And most of it is concentrated in small firms. So small firms in that sense are more risky and more prone to earnings management. Right? So that would be the Indian evidence on earnings management.
Okay. So having said all of this, as an investor, I can be careful. I mean, if I'm a long-term investor and I really care about the stock that I'm investing in, I can read, I can do my homework, and I can be careful. But there's another way in which I, as an investor, have some right, which is to enforce certain mechanisms for a firm to sort of comply with these kind of things, or to say that, as an investor, I'm not happy with what the firm is doing. So are there ways that a firm can introspect and put measures in place? They could do things of their own accord?
I think you're talking about governance in general.
Right.
Right. So good governance is generally going to help reduce earnings management, the bad earnings management. And I would say the first thing is we want good auditors who are evaluating the financials carefully. And so we want to invest in companies which have good auditors, who have a reputation for doing good audits. The board of directors, you want to look at the quality of the board of directors, because the board of directors do evaluate the financial statements. In fact, every quarter, there's a board meeting where they sign off, the board of directors signs off on the quarterly reports, right? So if the board of directors are high quality, then you can be more confident this company is a good company and is not engaging in earnings management. There are many other mechanisms like that, and shareholders should, be aware of that. But I think the more important thing is, as investors, we should be more diligent and invest time in learning about earnings management, learning about investing, which is what this whole seminar series is about. So there are 2 more talks in the series. So I think you should pay more attention, because you're putting good money into the market, you're investing in stocks, and so you should be careful. And so invested in education should be strengthened, right? And from a regulatory point of view, I think there should be, India is a good country which has a lot of laws, but very poor enforcement. That is the general adage. And I think the penalties for fraud should be strengthened, should be increased. And that should put more fear in the minds of the managers who are thinking about earnings management, right? So that's one way it can go down.
So let me just check how we're doing on time. Aishwarya? You can go on. 3 more minutes, okay. So yeah, the reason why I asked was I saw you mention Krispy Kreme somewhere.
Yeah, okay.
So very intrigued about what Krispy Kreme is all about.
Sure.
In the context of earnings management, at least.
Okay. So this is just one anecdote again. This is a famous case of a firm that engaged in earnings management. This just to give you a little bit more flavor about a real world example. So Krispy Kreme, makes those delicious donuts, which are very popular. Yeah. I didn't know that they were sold in India also, but I think many of you might have tasted them. But they were not a good accounting company. They made good donuts, but their accounting was not so good. Right? So they were a hot stock in terms of the IPO market. They went public in 2000 and got a good price for their offering. And but the sales was not doing well, and so it was going down. So immediately there was pressure to maintain sales at high levels. So what did they do? They started engaging in earnings management. And so what it meant was they started booking revenues when they should not have booked the revenues. So they would take they were selling donut making equipment to their franchisees, right? So remember, it's a franchise, and they were selling donuts. They were also selling equipment to their franchisees. And so they would just take their equipment and ship it to the franchisees, even though the franchisees were not ready to accept the delivery of the equipment. So they were just pushing it out and calling it a sale, when in fact it was not a sale, right? And so the epitaph, of course, is not very sweet. Finally, it came out that they were engaging in this earnings management, and they were forced to restate their earnings for over 5 years. And the price, which was about $50 a share when they were doing really well, fell to about $7 when the fraud came out, right? So the bottom line is fraud happens, and when it comes out, it's very ugly. People in the US especially have gone to jail for that, and it's not a good thing. And as investors, we should be very careful, do our homework, read the annual report, or at least seek somebody's help and try to learn financial statement analysis well. And with that, I think we're
pretty much good on time.
Okay.
So I think there are a couple of questions.
Okay.
Related to the discussion today. So the first one is, do financial institutions manage earnings?
Yes. I mean, these are all, I have to be careful because I might get a lawsuit if I say that. But the ability and the incentive, think about it as ability and incentives. They do have the incentives to manage earnings because, again, many of these bank stocks, for example, are traded. SBI is traded. Many other banks are traded on the stock market. So they have the incentives to manage earnings. If you want your price to go up, you may want to engage in earnings management. And they do have the ability. For example, we talked about loan loss provisions, which is a very big expense in the bank financial statements. So they could reduce it when it's not required to be reduced. Okay. Right? So yes, they can engage in earnings management.
Okay. So there's another very interesting question, which is, if companies manage earnings, is it more probable that they may have a default risk?
In the sense, would they go bankrupt? Again, it depends on how strong the governance system is. So I would say we are at the tip of the iceberg. The cases that are discovered, I would claim with a little hesitancy that most firms manage earnings. And some amount of earnings management is going on. There's a gray area everywhere, but most of it is not discovered. So if a firm manages earnings, it may reverse and not be discovered because it may be in the gray area, and so it may not result in a default risk. But studies have shown, many studies have shown in academic that it is a predictor of bankruptcy, right? So if we have not done a study for like that in India. We have seen these willful default cases, but I have a PhD student who's working on this to show whether earnings management can predict the willful defaults that have happened in the last 10 years in India, right? So it's a very good question and worthy of investigation.
Okay. So since you mentioned investor education is one of the key points in understanding these things better, one of the questions that has come in is, are there any good books, any good sources which would help a layperson get a hang of financial statement analysis and all of these things?
I think the starting book, there are many textbooks in financial accounting, and usually it's a good way to start because you learn some accounting, and the last few chapters cover earnings management. So for example, Professor Narayanasamy, who works for IMB, has a very popular textbook, and he has one chapter devoted to earnings management. So it's good to learn, first become strong in accounting, and then that's accounting 101. And then you learn about accounting 102, which is earnings management, right? So that would be my suggestion.
Fine. So if anyone else has any questions, you can put it in the chat box. Or you can raise your hands and they will allow you to go live. Any other questions? Yeah, so if there's any other question, you can put it in the chat window, and Professor Rangan will be happy to answer those questions. Yeah, that's done. Okay, fine.
Okay.
So on that note, thank you so much.
Thank you to everyone for listening patiently to us, and I appreciate your questions. And if you have more questions, books to improve knowledge on personal finance. I think I hesitate to answer this question because there are so many books, and I think to be fair to all the authors, I should not promote any single book. I already did one promotion for Professor Narayanasamy, but I've read that book and I can vouch for it.
Exactly.
But I think there are a lot of them. Amazon is a good source. But if you need more help, please write to me. My email is on the IMB website, and I can do some research and get back to you. Okay. Thank you very much. And with that, we'll say bye and hope to see you again, maybe another webinar on another topic.